Welcome to the Savills Shares podcast, where we discuss the latest development in the real estate arena. Our guest today is Jeremy Lake, Managing Director of Investment Sales and Capital Markets at Savills Singapore. Welcome to the show, Jeremy.
Thanks very much, Jack. Nice to be here.
Now, you have been to Savills for over 4 years now, but you actually arrived in Singapore in 1991 from London. Now, that's 33 years ago. What do you miss most about London?
I haven't thought about that question for a long time, Jack. 33 years, 1991. Seasons, I suppose. UK has seasons, albeit not necessarily the nicest seasons, but certainly some variety to the weather, which we don't have so much here. So that would be one thing. Something else I miss is scenery. Again, Singapore doesn't have so much scenery, so that would be something I miss. And then the third thing that I miss would be the long summer days. Again, where sunrise at 7 a.m., sunset at 7 p.m. Nice, but certainly the longer summer days in the UK would be something that I miss. But I can't miss them too much because I've been here so long. So generally, there's not much I miss.
Based on your experience and observation in the last 3 decades in the real estate industry, how has the Singapore property market changed?
It has changed quite a lot, actually. When I first arrived, it was a very kind of local market. Developers would occasionally sell properties to themselves. There were very few foreigners or foreign investors. We didn't have any REITs. We didn't have property funds. So the landscape in terms of the market participants has changed enormously, become very international, or much more international, with the global investors investing here. We now have lots of property funds, real estate investment trusts, pension funds. So the changes are quite significant. Some of the developers who are around, who were household names in the 90s, are no longer around. They've either disappeared or been absorbed into larger entities. And certainly the developer profile has changed quite substantially, and there are many more new players here, and many of the contacts that we might have had in the 90s are no longer relevant to the ones that are active these days.
The total investment sales activities amounted to about 20.5 billion compared to 28 billion in 2022. Now that's a drop of 27% in total. Are you surprised by that?
Not really. We have to look at 2 components for investment sales. One is government land sales. So we don't have control over that. In any given year, the government may sell more or less. So if it's a year they sell less, then it will contribute less to the overall volume. If it's a year they sell more, it will contribute more to the overall volume. So I think this 2023 was not a large year for government sites, so that contribution was relatively reduced. Then, of course, the private sector, which makes up the other portion of total investment sales, that has been impacted with high interest rates, inflation, etc., and the volume of transactions is lower, and therefore the results you mentioned don't surprise me at all, actually. But we would expect maybe in 2024 the numbers to pick up again.
Technically, with the ABSD increasing to 60% for foreigners buying residential properties, that surely would have helped the commercial sector.
The transaction costs for residential, which have attracted a large number of foreign investors in the past, become almost prohibitive, I would think, now. 60%, you would think that a foreign investor wouldn't be willing to pay that. So 2 choices: either they decide not to invest in Singapore, or they decide to invest in an alternative asset class. I think it is more likely the latter, but there's some adjustment period. If originally they were focused on residential, they don't suddenly flip into office or industrial or hotel or shophouses exactly. Maybe there's an element of learning and understanding that other asset class, but I don't believe this money will stay away. It will flow into other asset classes, but there might be a gestation period of 6 months, a year or 2.
Savills Q4 investment briefing reported that the shophouse market has declined for 2 consecutive quarters, with only 2 transactions in the last quarter. Why do you think that is?
A few reasons, perhaps. We have had the money laundering kind of fiasco issue, which surfaced around middle of the year, We did see a very strong presence from some Chinese buyers leading up to that news. As a result of the investigation and the arrests, some buyers have left the market permanently, and others have chosen to adopt a much more low-key profile for the time being. I think they will return, but maybe the preference has been to lie low for the time being. So that community, which was very important to the market, is not as large as it was. I think for some other investors, whether they're high net worth Singaporeans or other Southeast Asian buyers, maybe the higher interest rates, slight uncertainty with the economy, inflation, some fatigue, some resistance to current pricing, all those factors have perhaps resulted in a little bit of a wait and see. So it doesn't surprise me a great deal, and we can perhaps look forward to a pickup in activity progressively through 2024.
2 weeks into January and already Savills has 2 shophouses on the market. Does that signal the downward trajectory will see a reprieve in 2024?
I guess step 1 is to put the property up for sale. Step 2 is to get it sold, Jack. So we've only achieved step 1 thus far, but these 2 properties are very interesting. The lump sum is quite palatable. They inspect very well, so the location is very good, very close to the MRT. So we would hope that the interest level would be quite strong, and we would be able to achieve step 2, namely sell them for a good price. But that's still work in progress, early days, but we're still confident.
Earlier this year, you announced the sale of Scotts Square with more to follow. What is the attraction of a retail asset like Scotts Square?
Scotts Square is almost on Orchard Road, so the attraction is Orchard Road, I would say. Orchard Road is the most famous street in Singapore, I would say. It's a street that's well known to people here and overseas. So when a property is put up for sale on or very close to Orchard Road, as is the case with Scotts Square, it will always attract interest. A number of properties the last 6-12 months have been sold, but these have been development sites, and development is not everybody's cup of tea, or they don't have the capability to take on development projects. So where Scotts Square is slightly different is that it is an existing shopping mall, and therefore one can buy the property, enjoy the cash flow, and in fact the idea that we're selling is that you can improve the cash flow, maybe reposition the mall. So it's the opportunity to buy something just off Orchard Road that is up and running, where there's a potential to improve the cash flow, is something which works with a lot of investors. And the lump sum is both large but not too large. The asking price or the guide price is $450 million. So surprisingly enough, there are plenty of investors who do have that capacity. So a combination of those reasons would make this opportunity quite exciting, and we've already received a lot of interest from potential buyers. So we'll find out more in February when the EOI closes.
Is this the right time for an acquisition of this nature?
I would say so. There have been a few deals I mentioned on Orchard Road. The top end of Orchard Road has been a bit quiet, perhaps over the last decade or so, and it is timely for some repositioning. I think the URA, Singapore Tourist Promotion Board, is anxious to reinvent Orchard Road. And in the last 12 months, 18 months, there have been a number of redevelopments announced. One of the more noteworthy ones would be the redevelopment by Hotel Properties Limited for their former Hilton Hotel and Forum Shopping Centre, which is an enormous scheme of maybe 1.2 million square feet. That and a couple of other projects which are likely to be redeveloped over the next 2, 3, 4, 5 years will really change that end of Orchard Road. So there's some buzz about Orchard Road, and therefore an opportunity to buy Scotts Square just off Orchard Road would piggyback on that buzz. Secondly, interest rates have probably peaked, so the greatest pain in terms of financing costs has probably passed. And I feel that investors are beginning to think that the bottle is half full rather than half empty. So in answer, I feel it's a good time to sell. I think that we would get a good response and get a good price.
Is this a good time to buy?
Good time to buy. These assets, are never cheap. You buy, and within 2, 3, 4 years, you're kind of like very pleased. Maybe the first day you buy, you think, oh, that was a bit expensive, but people buying this will be thinking long term. And on the back of the improving outlook in Singapore, on the back of the transition on Orchard Road, I feel it's an investment that somebody will be very happy they ended up buying it if they're successful.
Last year, we saw the acquisition of Jurong Point, Swing By at Thomson Plaza, 50% of Next and Changi City Point. Seletar Mall is also said to be in exclusivity according to media reports. In Savills' Q4 investment sales briefing, there is a view that retail assets may find better prospects this year due to the scarcity of prime stock for suburban malls and lack of new sites in Orchard Road for retail redevelopment. That plus the higher yields that retail assets carry. What are your views on this?
I think the yield is a very important factor, with the cost of borrowing being so much higher these days, perhaps at or above 4%. Many investors are very conscious of the yield that they will enjoy when they buy a property. From a Singapore perspective, office maybe 3% or 3.5% or so, retail maybe 4.5% or so, industrial maybe 6 or 7%. So vis-a-vis the cost of borrowing, retail and industrial are more appealing perhaps, just because the yields are higher. So that's one factor that has probably supported the interest in the retail asset class. Suburban malls in particular, I think after COVID, everybody gets it. These are a very resilient asset class. The shoppers live within a couple of kilometers. It's non-discretionary spending. They're not going anywhere. So that as an investment, you should do well. Risk should not be high. So that is popular. And then thirdly, Orchard Road in itself is always popular if the right asset comes along at the right price.
Savills has projected the total investment sales coming in at 22 to 23 billion for 2024, due to a more active GLS market and better prospects of interest rates falling in the second half of the year. This is a forecast of a 10% better performance than last year. What is your sensings of this?
Makes sense. I think we've acknowledged that 2023 was a bit of a low point for reasons that we have discussed. Some of the clouds which have been over us the last 12, 18 months are blowing away. Interest rates are likely to decline. Investors who have been sitting on the sidelines may come out of hibernation and be more inclined to buy in 2024. So I think the private sector should do better than last year, and the government land sale program, from what I've seen thus far, is quite sizable in 2024. So the sum of the two parts should generate a total volume which would be certainly not less than 10% of 2023.
Savills has been the number one player in the collective sales space for the last few years. What with sales of Tanglin Shopping Centre at 868 million, Ming Arcade at 172 million, Flynn Park at 371 million. So what is the outlook of collective sales in 2024?
The collective sale market has been a feature of the Singapore property market for 25 years. It tends to perform in cycles, activity, inactivity, activity, inactivity. We are now in a period of inactivity, which is due to unusual circumstances, a confluence of circumstances which are as follows. One, the residential property market has performed well in Singapore the last few years. Despite COVID, we have seen property prices go up. So if you want to buy a residential property today, the prices are quite high relative to the past. So when owners set their reserve price that they want for their collective sale, obviously they're looking at the cost of replacement properties. How much do I need to buy a replacement property? So this probably results in them continuing to set high reserve prices. Just the cost of replacement is high, so therefore I need to sell my current property for a high price to allow me to switch. In addition to that, the transaction costs have increased. So whether you're a Singaporean with your second property or a PR or a foreigner, ABSD has increased. So the transaction costs have increased when you switch. So for these two reasons, reserve prices are high. Unfortunately, at the same time, developers' bids have gone down because construction costs have increased, interest rates have increased, some regularization or harmonization of floor areas has eroded the saleable area that developers have. So the prices that they're willing to pay have gone down, such that we now have a significant price gap. So that price gap will continue into 2024. The only caveat I would add is that for non-residential collective sale properties, where you have owners who own a hotel or office or retail or industrial, they are not necessarily afflicted with the high replacement costs per square foot, nor are they afflicted with the high transaction costs, and therefore maybe their reserve prices are more realistic or more attainable, and therefore developers may bid, and you may find that we don't have the price gap that we do have with residential properties. So I think we will continue to see healthy activity in the non-residential space, but historically that's been a relatively small part of the overall market. So the overall market will remain very subdued.
You make a comment previously that Singapore is a safe haven, and as such, it attracts the ultra-high net worth families. What makes Singapore a safe haven?
Political stability, rule of law, security, safety, nice place to live, strong financial community. These are all attributes that are appealing both to those of us who live here and also to foreigners who may want to come and live here and or invest here. So these are, I changed my phraseology recently. I used to say Singapore was Asia's Switzerland. Now I feel it should be Asia's Monaco. Switzerland is a very big country, whereas Singapore is not. Monaco is a very small principality, so maybe there's some greater similarity between Singapore and Monaco. But it's a place that people know in the region globally for all the reasons I mentioned, and it's certainly a safe haven.
It's a brand new year. So what are you and the Savills investment team most looking forward to in 2024?
More active market. Last year things were slower, more wait and see. I mentioned many buyers were hibernating. So we feel that the hibernation period is probably coming to an end for some, not all buyers. Buyers move at different pace. So we feel that there'll be more buyers willing to step into the marketplace, and we are looking forward to matching them up with properties for sale. So deal volume is probably the greatest excitement that we have. We all are brokers and we all like doing deals, and I think 2024 will be a better year, most certainly, than 2023.
Last question, Jeremy. I understand that you are a man who eat to live versus live to eat. But what is the one dish that you think is a must-eat in your book?
I am very fond of laksa, and I'm also very fond of chicken rice, but chicken rice has to be breast meat. So my wife enjoys going out for chicken rice with me because she prefers the dark meat, and I prefer the breast meat. So chicken rice would also be one of my favorites.
Thank you, Jeremy, for joining us today. And that's all the time we have for today. Catch us next time on Savills Shares, the podcast, available on Spotify, Apple, as well as YouTube Music. Until then, have a blessed week. This podcast is for general information only and should not be taken as professional advice. Savills accept no responsibility or liability for any direct or indirect or any consequential loss from the use of, reference to, or the reliance on this podcast or its content.